It's the fourth Saturday of the month and it's time for Finomoney, the FinTech show. I'm Ajay and let's look at what we have for you on the show. First up, we take a look at why valuation of startups and new age tech companies have come down in our special package. Followed by the special discussion with Mr. Rajiv Das, CEO, iLoans Loan Tap on digital lending. And then the trivia segment Finogyan on why overseas credit card spends will carry a 20% tax collection at source. And now it's time for the Big Five, the headlines, the movers and shakers that has left an impact in the world of fintech. First, insurance regulator IRDA will be hosting an open house for insurtech and fintech companies on the 15th of every month. The move is being done to bring in more innovative ideas for the insurance sector. IRDA said that the open house will invite suggestions from insurance companies to provide better services to policyholders. IRDA's chairperson, along with senior officials, will be present at the open house. And earlier this week, PayNearby has appointed Saif Khan as its Chief Growth Officer. The company, in a press release, said that the appointment is in line with the fintech's plan to drive growth across emerging businesses and channel partners. The new CGO will help to strengthen the firm's existing business strategy and exponentially grow both the top and bottom lines, and at the same time enable the finest techniques to close the urban-rural gap. And PB Fintech was out with its fourth quarter results, wherein its losses narrowed to 8.9 crore rupees. In the corresponding period last year, the company had posted a loss of 220 crore rupees. The revenue from operations jumped 61% year-on-year to 869 crore rupees in the fourth quarter, as against 540 crore rupees in the corresponding period last year. And Paytm Money has launched a bond trading platform for retail investors. Now, using the platform, investors can buy three types of bonds, namely government, corporate and tax-free. Speaking on this launch, Paytm Money CEO Varun Sridhar said that bonds are the best way for first-time investors to enter capital markets. Bonds on the Paytm Money app will make it easier for investors to analyze and understand the returns they can earn. And PhonePe once again secured some additional funding from General Atlantic. The fintech behemoth has secured an additional amount of $100 million. With this, the total investment from General Atlantic in PhonePe has gone up to $550 million. In total, the capital infusion has taken the raised fund of PhonePe to $850 million of primary capital in the current round. Up next, valuation of companies have taken a steep hit. Various venture capital companies have cut down the valuation of startups and new age tech companies. Some of these companies include the likes of Swiggy, Oyo and much more. What's the reason behind this slumping valuation? Our special package will tell you just that.
The American fund manager Invesco recently slashed down the market value of food aggregator Swiggy from $8 billion to $5.5 billion. Invesco has invested around $700 million in Swiggy. The market value of the online food delivery app has come down to $5.5 billion, which means that it has become smaller than its rival Zomato. The market value of Zomato is said to be $6.9 billion. However, just like Swiggy, Zomato was also in the same situation. At one point of time, the market value of Zomato had crossed $13 billion. Swiggy is the second decacorn which has seen a decline in its valuation. Earlier, American investment company BlackRock had reduced the valuation of edtech company Byjus to $11.5 billion. This was the same company which had a sky-high market value of $22 billion during COVID. Back in September last year, SoftBank also reduced Oyo's market value from $10 billion to $2.7 billion. Recently, American investment management company Neuberger Berman also reduced the valuation of its two Indian portfolio startups, Pine Labs and PharmEasy. Their valuation decreased by 38% and 21% respectively. Prior to this, Valuations of many big startups like Snapdeal, ShopClues, Quicker, Hike and Paytm Mall had also plummeted. You will be able to get a clearer picture of the dire situation of startups from a report by market research platform Traction. There are currently 115 unicorns in the country, out of which the data of 80 startups is publicly available. And according to this report, out of the 80 startups, only 17 unicorn startups are profitable. So then, why are the valuations of startups coming down? The decline in Swiggy's market value comes at a time when startups are posting huge losses and are resorting to layoffs as a part of their efforts to conserve cash and focus on profitability. Significantly, in January this year, the online food delivery company had fired 380 employees. The company cited challenging economic conditions and sluggish growth in its business as the reason. And this is not just for Swiggy. Many startups are more or less in the same situation. In the first 4 months of 2023, 41 startups had laid off around 5,868 employees, whereas in 2022, 52 startups had laid off about 18,000 employees. Now coming to funding and other issues. This retrenchment has to do with the decline in funding. In recent times, there has been a huge decline in funding in Indian startups. Funding has seen a decline of more than 20% on an annual basis. Industry experts opine that one of the major reasons for the deteriorating condition of startups is that they tend to overestimate their growth, and while getting huge investments, they also do heavy hiring. Later on, this hiring becomes a burden on them, and then they resort to retrenchment. That is, there is a lack of focus and direction. There is also no clear strategy regarding the expenditure. They are spending heavily on advertising and marketing. Take the example of skincare startup Mamaearth. This startup has spent 42% of its sales in 2022 on advertising and marketing. Back in March this year, they had to put its IPO on hold after doubts were raised on its valuation.
Alright, we now focus on our special chat. This week too, we will be focusing on digital lending, and to talk on this, we have Mr. Rajiv Das, CEO, iLoans LoanTap. Welcome to the show, sir. How are you?
I'm fine.
Alright. My first question to you is, how will the reduction on subsidies in the FAME 2 affect the demand for electric two-wheeler loans?
Actually, we have to understand two important things about the EV industry. Basically, it's broken into two parts. One is the high-speed vehicle and the low-speed vehicle. One is expensive vehicles, which are at the high-speed range, and then is the affordable range. That is the low-speed vehicle. Low-speed vehicle is basically, in the family-driven. The people who are using it are the homemakers, the children, the elderly citizens, and all the traders community, which has a range of around 30 to 40 kilometers on a daily basis. So these are the target segments. The expensive segments are that which gives you a higher mileage. You can say it runs for 120 kilometers. It can run on a higher speed and all. So if you consider FAME subsidy as such, so this will definitely impact little bit on the higher segment. But on the low speed segment, it is not going to impact much. But if you see the subsidy in case of subsidy which has been given by the government of India, so it's always said that no time is the right time to remove something on the subsidy side. So the government of India wanted to actually help target the segment, because green energy was a very big segment which had to be targeted globally. Okay, so it was not only India driven, but it was also globally driven. So the government had a kitty, you can say, which was kept for green energy. So it consists of electric two-wheelers, three-wheelers, even solar panels and all the hydrogen vehicles which have come into the place. So that is the segment which they have a kitty. They had it till 2027. Yes, in this budget, they have increased it to a higher level. However, if you see the impact of this impact will not be higher. On the expensive segment, the people in the expensive range of vehicles of electric two-wheelers will break out new models, with a lower speed. It's a mileage of 120 will give you a mileage of 90. They will reduction in cost and all. But overall, the government has driven the electric two-wheeler segment in a very positive way.
All right. My next question is also on the same issue. Do you think removing this subsidy is happening at the wrong time where inflation has stabilized and the lending rates have also not gone up for now?
Yeah. So, see, again, no time is a good time. So, but the government has understood what is required. They have put the on a growth margin. Okay, of course, it's not expected that it had to be a 10% total exposure on the electric vehicles on the segment of two-wheelers, but definitely it is reaching the mark. So it has given that kind of initial trigger to it. The subsidy will bring out new competitions. Okay, so the OEM segment, which had been unregulated for a long time, okay, now they have been regulated. And if you see the new guidelines which have been formed by DHI, the Department of Heavy Industries, which is linked to MHI, okay, the Ministry of Heavy Industries, they have bring out new guidelines. So initially the team, the people who were in the OEM structure, which were unregulated, they had bought on new vehicles. Okay, so nobody was knowing what exactly is the guideline. But however, with the new guideline, the introduction of 156 IS batteries, which are more dust-proof, fire-proof, explosion-proof, and weather-proof, you can say. So this kind of things, and also there will be regular checking on the vendors who are supplying this kind of materials to this manufacturers. So I think so. The whole industry as a segment will get actually legalized. Okay, and the people over here will get a better vehicle because there is always a lot of news going on around vehicles catching fire or vehicles not working and all. I think so that will actually put an end to all these questions, and the subsidy will be a little bit a dampener initially, but I think so overall, if you see a lot of affordable vehicles, people will move to low speed vehicles, and of course, which contribute around 70% of the electric two-wheeler industry.
All right. Moving on, Mr. Das, how has the recent changes in the LRS scheme where there would now be a 20% TCS on transactions above 7 lakh rupees impact the travel loan segment?
LRS payment, as we know, it was disproportionately, high when compared to the disclosed incomes. So the government has actually come out with a scheme where this initial things can be put into the scanner. Okay, it has actually clarified. So a lot of people had this apprehensions that people who are moving to on companies they have traveling on company travels and all, so they might get affected. Whereas the ministry has already clarified that this will not be under the purview of that, and it can be done. The credit cards usage, if you see again, they were absolutely disproportionate to the disclosed incomes. Okay, so which the people have been. So there will be a 20% tax. Also, of course, that 2 lakh bracket on an individual travel to a foreign country will also be put under the scanner, and they have to disclose it in the tax, whether if it is crossing the LRS scheme or not, it doesn't matter. So regulations, of course, are there. Initially, there might be hiccups for few travelers, but I think so overall people will able to understand and move ahead with this.
All right. Just one last question before we let you go. How has the funding winter and the regulatory hassles affected your product positioning strategies of your existing portfolio?
So, as we know, all NBFCs and banks are regulated entities by the RBI. So, we being a regulated entity, it has not actually affected us. Yeah, some players on the fintech industry who were not regulated, all of that, and they were having a lot of schemes and all. They have been a little bit impacted, but now they have understood that we have to put it in a framework. The government has given that framework, and people have to work within the framework. So a lot of marginal players might get affected, but of course the regulated entities will not get affected, and there is a huge competition. The competition brings better rate of interest to the customers, better service. So people are moving. So the traditional banks, which used to take a longer time, that is the perception also, the people have also moved digital. Okay, so the digital is the new thing. People want faster loans, faster service, and a better rate of interest. So I think so the overall competition will mature enough, and the end use, the customer will actually get benefit from the entire scheme of things.
All right. That's all the time we have for this discussion. Mr. Rajiv Das, thank you so much for coming and sharing your insights. Take care.
Thank you. Thank you.
Now, every time you make a card transaction, you would be asked to enter the 16-digit card number and the CVV number. But card company Visa is changing all that by bringing tokenization. So what is tokenization and how it's useful for you? Find out in Spendwise, premiering tomorrow Sunday at 4 p.m. only on the Money9 English YouTube channel and on the Money9 app. Download now. And now we have almost come to the end of the show, but before you go, make sure to check out Finogyan to know the reason behind the 20% TCS on credit card transactions done abroad.
If you are planning a trip abroad, then most likely you would do whatever it takes to make sure that you don't exceed 7 lakh rupees when using your credit cards. Because if you do, then such transactions will now carry a TCS or tax collected at source of 20% under the liberalized remittance scheme. But why is the government bringing this change? And what you should keep in mind while making international credit card transactions? The answer to these questions lies in the video of Finogyan. Earlier, payments done through debit cards were treated as LRS. However, individuals started exceeding the LRS limit using their credit cards, and the expenditure incurred on the transactions was not accounted for under the specified LRS limit. And adding to that, the differential treatment between debit cards and credit cards had to be removed to bring uniformity in treatment of drawing foreign exchange. Now, what must you keep in mind when using credit cards abroad? Well, there are two things. Number one, you will have to pay TCS when using an international credit card for international transactions. And number two is that you must claim credit for tax payment when filing annual income tax returns in India. Now, some of you would have not filed tax returns previously, but now they will have to do so to be able to claim credit for TCS paid on overseas transactions using an international card.
Well, with that, it's time to draw the curtains on today's Finomoney, the FinTech show. Download the Money9 app and stay tuned to Money9 English's YouTube channel. See you all again in June. Until then, this is Ajay signing off. Take care, goodbye, happy weekend and adios.